Welcome back to Money Mind. By 2025, China and India will be two of the world's four largest economies, and by then, economic ties between them should rank among the two most important bilateral ties worldwide. So how can companies within these two economic giants benefit from the growth? I sit down with Professor Anil Gupta, one of the three co-writers of a new book, The Silk Road Rediscovered, to find out how winning in each other's markets is whetting their appetites to take on the world. When it comes to relations between two of the world's largest economies, it's often a case of the good, the bad, and the potentially ugly. For those interested in stable, cooperative Sino-Indian relations, the signs are looking good. A new book, The Silk Road Rediscovered, says Chinese foreign direct investment into India could touch $30 billion by 2025. But how the relationship between India and China plays out will depend on a number of internal, bilateral, regional and global factors. And according to one of the co-authors of the book, Professor Anil Gupta, this growing expansion and the success of it, or otherwise, might just depend on gravity.
It's really the gravitational pull of the market sizes that's drawing companies from each of these two countries to look seriously at each other. Now, I would say still it's the early days, but I think we can expect to see significantly larger numbers of companies over the next 10 years.
But there have also been underlying tensions between the two countries as well, despite that growth. You say, though, that there are good reasons to predict that these economic ties will actually continue.
Relationships between countries, they move along on two parallel tracks. You know, those two tracks are interconnected. So one is the geopolitical, and that may be full of tensions or maybe not. But at the same time, even in the presence of geopolitical tensions, like between China and Japan, the economic relationship may continue to follow its own course. In terms of the geopolitical relationship between China and India, there are no fault lines like there are between China and Japan.
So what about the key drivers for investment opportunity for India and China?
You know, it's almost like, you know, the story of the robber, you know, who, when the judge asked the robber, you know, why do you rob banks? He said, sir, that's where the money is, right? And so it's really the pull of the market size. You know, if China is a big market, if India is a big market, that's where the money is. Number two is that especially in B2B markets, that as Indian companies, for example, in the IT sector, that they are very strong globally, and they have large global clients, you know, be they Walmart, be they Procter & Gamble or others. And clearly, those companies would prefer that Indian IT vendors serve them in China. And so therefore, you know, Tata Consultancy Services, if they are not in China, they're not serving their customers completely, you know, from a geographic point of view.
But one of the underlying tensions, Professor Gupta, is perhaps this growing imbalance in favor of China, in fact, of bilateral trade. Yes. What's the significance of that imbalance, do you think?
70% of the trade deficit is because of India's imports of energy. And that has nothing to do with China. 20% of the trade deficit is indeed because of the trade deficit with China. The trade deficit that India has with China, it's primarily because of China's exports of machinery to India, which is not only much less expensive than that from Japan or the US or Europe, and often comes with low-cost financing. So therefore, actually, that is good for India.
Right, so those economic ties that you describe, Professor Gupta, they're actually dominated by trade rather than investment in any case. Do you see that balance changing at all? And what's going to change it?
As India's economy begins restructuring, and India goes through an infrastructure revolution, a manufacturing revolution, and so on, and the size of India's market becomes bigger, that actually there would be significantly greater opportunities for Chinese companies, much more so for Chinese companies into India than Indian companies into China.
The Silk Road Rediscovered says in order for companies from India and China to make it in each other's market, they need to remember some key points. Have a roadmap that includes a long-term view, see each other as part of a global strategy, beware of tough competition, and don't get complacent. So what are the key strategies that have worked and which companies have benefited?
You have no business to be trying to play in another market unless you have some competitive advantage that you can leverage. And so for Indian companies, be it Mahindra or Tata Consultancy Services or Tata Motors, through Jaguar Land Rover, the starting point is that do you have some strong, hopefully global level competitive advantages either from India or from your worldwide positions, including India, that you can leverage when you enter China. Number two is that don't think of your strategy for China from a narrow lens, which is in China for China. Rather, think of it in terms of, for the world, how can we leverage our global positions for China and how we can leverage the operations that we build in China for global strength.
But there have also been companies that haven't been so successful. What are the ones that stand out for you and where did they go wrong?
Haier, they are doing okay, but they are, not one of the top 3 players in India's home appliance market. And some of the main reasons why is, number one, that Haier entered India late. So they entered India around 2005, while LG and Samsung entered India around 1997. And LG in particular already dominates today, dominated in 2005.
Professor Gupta, you've said that for Indian executives, one of the biggest obstacles for doing business in China is the Indian mindset. Can you explain that?
China can appear too big, too daunting, too baffling. But there's a way around it. And the way around it is not to think of China as one market, but to think of China as hundreds of market segments, geographic, within industry. And nobody, not even IBM, when they entered China, went after the whole market. Not even Microsoft. Nobody, goes after a big market.
That's our show for this week. Thanks for watching.